The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, everybody. This is Ken Cavula from the Mid-Michigan chapter of Better Investing. We'll be starting the roundtable right on time at 8:30 Eastern Standard Time. I have about 19 after, so we have 11 minutes to check sound equipment, to answer questions from the audience,
and get rid
or
of
just to chat. Mark is already here. You just heard from him, and Cy is here already, and we're waiting for Kim, and we're waiting for Nick Strategos from Pittsburgh to join us. So, in fact, Kim is in the audience, so I'm going to move her back to the back room here. Welcome, Kim. Welcome, Kim.
I'm coming.
We heard her. Okay. There's no rush. Don't panic. Okay.
You need a snorkel down
No,
here.
I gotta get the. Yeah, we do.
Yeah, we're getting.
It's coming to you. It's coming to you.
The swirling part of it's going to come right through the center of Michigan, but they're expecting only about somewhere between a half an inch and an inch of rain. Which is just kind of normal soaking. So,
yeah, we have had virtually not non-stop rain, as in it doesn't break, but every day for over a week. Even before Alberto came around, I think we had it. Now we've gotten that. So
did you see those pictures of that town in Maryland? That's just unbelievable. That water just flowing through the main street like that.
Yeah, that is absolutely unbelievable.
So those of you out in the audience, if you have a question, I'm going to be monitoring the chat during the evening, the question box during the evening, so you can talk to us via text, or if you'd like to talk to us out loud, I've made it so you can raise your hand. If you look at the icon right now, that icon is indicating that your hand is not raised. It's a little bit, it's an icon that's a little bit hard to decipher. So look at it now, and it's not raised. If you press it once, then it'll send me a signal that you would like to actually speak out loud, and I'll unmute you and we can talk to you. Shout out to a number of the Mid-Michigan folks that are here already. And Herb's hand is in the air, so I'm going to unmute Herb. Herb Lemkel is one of our directors from beautiful Traverse City. Herb, you're unmuted. Can you hear me okay?
Well, good evening, everybody. Welcome to the May 29th, 2018 edition of the Roundtable. This is actually part 2 or a redux of the session that we gave at the recent NAIC Better Investing National Convention in Orlando just a couple of weeks ago. Everybody had the opportunity to switch out their stocks, but everybody was either confident or stubborn that the audience would select them this time, so we're going to go ahead and press on with it. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here tonight by guest damsel Kim Butcher from Fort Lauderdale by way of Evansville, Indiana. Ken Cavula, again, a national educational leader for the Modern Investment Club movement of nearby Michigan here, mid-Michigan. And the guy directing the orchestra in the middle is Cy Lynch from Atlanta. That's me, and then farthest on the right is Nick Strategos with his clinching of the clinch that he has on the Stanley Cup there. So the five of us will be giving the stock presentations tonight. We were all recently together, obviously, in Orlando, and again, a big shout out to all of you here tonight. All right, the picture's up at the top. I just thought we'd just take a moment. You know, part of the National Convention is to honor people who have volunteered and given countless hours of time and attention to helping people figure out that this truly is a wonderful way to approach the challenge of investing. And we know all these folks. Marty Eckerly from Cincinnati is a frequent attendee at these events. He's there smooching over a glass of wine with his wife, Barb, so we also threw in that picture of Marty, again from Cincinnati. Joe Parks, he received a kind of a Lifetime Achievement Award posthumously in Orlando. He fell victim to a automotive accident about a year ago. And so Joe from Houston has just been a fixture in the national events and the Houston area for decades. Dave Swearinga, same situation. He does all kinds of stuff for the Dallas investing community. And last but not least, Phil Crocker, good friend of Hugh McManus, originally from New Jersey, now part of the Space Coast chapter down in Florida. Phil was recognized again for a lifetime of contributions to the Modern Investment Club movement. So again, we tip our cyber internet hats to all of these folks and express our appreciation and treasure the moments that we've had with them over the years.
You know, Mark, I'm sitting here and I'm thinking of how many years of volunteer experiences are represented by these 9 different volunteers on this page here. I'll bet you it's approaching 300 years, you know?
Could be. We should total that up sometime. I know that, of course, Cy's only been doing this for a few years, right?
Yes, Cy's just a youngster.
I'm a baby.
Yeah, Mr. Home Depot IPO. Okay. And of course, Kim is still 29, so she doesn't add to that number too significantly.
Love you guys. Just love you.
Just kidding. No, a lot of experience there on that page for sure. Here's a bit of housekeeping. Again, no investment recommendation whatsoever is intended. This is all about education. It's about taking the principles and the philosophies and the methods that we use in the Modern Investment Club movement and show basically what we do and how we do it. So please do your own homework. If you want to be included, or if you have a friend that wants to be included on the event email reminder list, please send an email to nkavula1@comcast.net. That's Ken's significant better half. And then if you do have questions or after the session, or you want to copy the slides, Mark R. at manifestinvesting.com. We're going to go ahead and press on. We did this session in a 50-minute time slot down in Orlando, and we'll probably try to stick to about an hour here tonight. It's a full session, but again, this is our traditional online session, so that we've got a recording to share with the world. Again, an introduction. Welcome to those of you that may be joining us for the first time. Big extra hug for you. We're going to talk a little bit about the results we've had to date. We've been doing this now for almost 8 years. We're coming up on our 8th anniversary in 2 months, so we'll probably have some celebrations then. We'll talk about Teva Pharmaceutical, the generic company that may be on the hot seat a little bit. And then we'll have our 5 stock presentations. You can see the tickers there. And we do always have an audience poll. You can pick your favorite from the 5 or none of the above. And we'll keep the floor open at the end for questions and answers and try to do that. Just a reminder of what we're doing here. We try to single out a favorite investment opportunity for study that each of the 5 of us are looking at. They're generally going to be in pretty good situation. Many of them are going to be core holdings, but we do tolerate less traditional selections from time to time for a portion of the portfolio. We do keep track. We're trying to beat the market by 5 percentage points. We define the market as the Wilshire 5000. And we also like to see that rule of 5 come true with at least 3 or 4 out of every 5 selections doing pretty well. So again, not to belabor the point, we're doing okay. We're doing better than okay. We're actually into the super investor zone, beating the market by now approximately 6 percentage points. The rate of return over these almost 8 years is now 17.4%. Over half the picks have actually outperformed the market. It's a dream to get to that dotted red line. We're there. We want to stay there. As Ken's investment clubs always remind him when they start their meetings, now don't mess it up. And we're trying to do the same thing. We'll watch the tracking portfolio, and we've been having a lot of fun over these last few years, and a lot of the picks have been quite rewarding because I know some of us have actually gone out and invested in them. Any comments from you guys on this one?
I'm just getting a comment. This is annualized return for those of you folks that were asking. That 17.4% is an annualized return since the beginning, year after year after year.
You might just take a moment for some of the newcomers in the audience to explain relative return, Ken.
Well, relative return is a real simple concept. We track where the Vanguard Total Stock Market Index Fund is on the night that we put our imaginary money into our chosen stocks. And we track, of course, what the stock price is, and then we watch them together. And for every stock that we put in the portfolio, including the ones that were in and then came out because we froze their position, we want to know, did the stock beat the market or lose to the market? Again, we use VTSMX, Vanguard Total Stock Market Index, as our yardstick, and that's what relative return is. We think if Nicholson were alive today with a computer in his hands, he'd be telling investment clubs to beat the market by 5 points on a regular basis. That's actually where the 15% came from. 15% is 5 points better than the stock market average, which for 100 or so years has been around 9 or 10%, depending on how you measure it. So we think that if the Modern Investment Club were just getting underway today, the goal would be beat the market by 5 points. That's been the Roundtable's position. That's been our goal since we began this thing almost 8 years ago. And, you know, there were times, Mark, when I never thought we'd get there. About 6.5 years into this, I started taking heart that the line was stopped, had kind of stopped dithering and was moving back up again. And once it started to move up from where it is today, I've been pretty happy with the whole shebang. We're above the red line, and the red line is beat the market by 5 points. So at 6, that's pretty darn good. 6 points above the market year after year after year.
Yeah, that's actually in a rare performance level, and we'll probably talk more about that next month and especially the month after that. So good stuff, guys. Thanks. Well, here's the stocks that actually have gotten us there. What you're looking at is one of our manifest investing dashboards. We're showing the top 20 holdings by size of position, in other words, dollar value of the positions. Every time we make a choice, whether it's one of the knights or a damsel or the audience, we invest $1,000 into the stocks that you see here. So, for example, Cognizant, thanks to a stubborn Cy Lynch, has been picked 13 times. So $13,000 have been invested in Cognizant over these past several years. You can see that 13,000 has now grown to be 24,000. So thank you for your stubbornness, Cy. And
you're very, very welcome.
Yeah, keep up the good work. So you can see from top to bottom, you see a lot of community names, but you see names like Universal Display. $3,000 invested in Universal Display is now nearly 12,000. So you can just use that legend or key up at the top. That link at the very top is a public link. You can follow along with a public dashboard to see. I think there's probably about 80, 85 active holdings in the tracking portfolio right now. Anything jump out at anybody on the call? As far as
I'll tell you, Mark, Universal Display had a wonderful day today. In the market debacle that went on today, market down about 400 points as measured by the Dow. Universal Display was up about 4%. They had a bang out earnings, and we had been remarking that it had been punished a little bit by the market in the last 6 or 8 months, and it was probably a great buying opportunity. None of us chose to pull the trigger, however, and I wish that we would have, because it's moving back near the top of this list, and it's really giving us great performance. Again, Mark told you that's $3,000 turned into $12,000 in a space of less than 8 years. We don't have a date on here as the first time we purchased it, but it was not one of our original purchases, so it's less than 8 years. Mark, we have a question about the red triangles next to C.H. Robinson and CVS. Is there a reason for them on the sheet?
Yeah, in fact, that's a good thing to point out. Those are actually activated alarms on CVS and C.H. Robinson. The alarm on C.H. Robinson was I wanted to be alerted if it dropped down to 80, and you can see that it was triggered, so I got an email. And then for CVS, I wanted to be alerted if it actually dropped down into the sweet spot, because it had been hovering up above the sweet spot. Now at 15.7, it's back in it. So those are just two alarms or alert settings that I had put in for some of the stuff. So we'll actually be entering in quality alerts on many of the companies, if not all of the companies. So we'll use that feature at Manifest to nudge us when there's a company that we should be taking a look at.
And Lynn, it's possible to remove those triangles. And in fact, now that you've kind of kicked us a little bit, we can go in and remove those alerts since they've been triggered, and since we got an email for them. They cannot be removed, so that looks like any other stock on the list then.
Mm-hmm. Any other comments, Kim? Any comments on S&B Global? You can certainly do a victory dance.
Oh, I have, and I will just say cha-ching, cha-ching. Big grin on my face.
Yeah, that $3,000 is probably what, a year or so old, and $6,800 already. And PayPal also.
Yeah. Yeah. Well, all I have to say is they were both spinoffs. That's why I like spinoffs.
The spinoff cha-ching.
I'll tell you one. I'm sorry. Go on, Kim.
I heard somebody say something's on a rampage.
Background noise. Your stocks
background noise, evidently. Yeah.
Oh, okay.
I'm noticing BP on this list, Mark, because when Hugh McManus chose BP, it was at the time that the oil spill had happened and they were leaking oil into the Gulf of Mexico, and people had given up on BP entirely. And Hugh's statement basically was the company's not going to go away. And if you'll notice up in the legend up there, BP is a 4-time selection. And so that $4,000 that Hugh put into BP has now turned itself into $6,000. That's a decent return for a huge stock that everybody gave up for completely dead.
Yeah, it's a great point. And there's two others on here that I would draw attention to. Bank of America. That's another one that he said, we were all holding our noses and gagging when he picked it several times, almost 8 years ago now. And that's turned out pretty well. And also Amazon.com. I believe Amazon is a 2-time selection. 2,000 is now 11,000. So this investing stuff does tend to be intriguingly interesting to me. That's an understatement. All right, let's go ahead and press on.
Mark, we're getting a question from Margot, and Margot wants to know what is PAR. Margot, PAR is potential annual return. And if you look on your SSG that you do through Better Investing, you'll notice in section 5 that there's a total return and a PAR value, a potential average return. They differ by when you would sell the stock. The total return is based on selling at your high PE estimate. The PAR is based on selling at your average PE estimate. And we tend to like the measurement of PAR. So the PAR on this sheet is exactly the same number that you would get in section 5 if you were to do a traditional stock selection guide. Bring it all the way down. PAR does include the dividend. That's part of the return. So PAR includes the stock price appreciation as well as the dividend.
Yeah, and the one point of clarification, the forecasts that go into that, the assumptions and judgments that go into that forecast, the growth rate, the profitability, the PE ratios, that represents a consensus of analysts that cover the stocks. So we literally have, Morningstar, Value Line, a variety of different analysts that cover the stock, and we basically have a consensus stock selection guide outcome that projected annual return you would recognize as section 5, as Ken was just saying. Good stuff. All right, let's go ahead and press on. One of the things that we do like to do as kind of a best practice is take a look at the portfolio, turn it upside down, and say who has the weakest return, the lowest return expectations. And there's really not many stocks with a low return expectation. We've done a low PAR. The only one that's even close to kicking around a little bit would be Teva. And I think we should kind of I know, Cy, you may have thoughts on this, but the Berkshire Hathaway has been accumulating this company. It's been in the portfolio for quite some time. Any thoughts on Teva and how you would treat it as a holding and how you would think about it, Cy?
Well, I think you mentioned a reason certainly to consider holding Teva is that Berkshire Hathaway's doubled their holdings. Also realized that the primary damage, both from a business perspective as well as a stock price perspective, happened in 2017. The company announced a restructuring plan in December of 17, and the price is up about somewhere between 15 and 20% this year. They beat expectations the first quarter. So kind of a long way of saying there's while I'm not particularly in love with the stock, I'm not sure that I would believe enough to buy it right now, but and it's certainly not a growth stock the way that it used to be. But I think one can make a strong argument that the worst is behind it.
Okay.
I'll balance that, Mark, by just indicating that we're shooting for a total average weighted par value of between 12.2 and 17.2. That's what we call the sweet spot. That's 5 to 10 points above the average. That 7.2 represents the average return, the average par value from the database that we're following here. And even if Teva is a core holding, that 0.3% par value is sitting down at money market returns, maybe even a little bit beneath money market returns right now. And if we're going to follow our discipline, we really should be taking it out of the tracking portfolio, thanking Teva for the profit it's given us, and moving on.
I have no, in response to that, I have no problem at all doing that. My main rebuttal is, and again, this is not about Teva, this is a general observation. We seem to be relatively selective about enforcing the par concern. I share the par concern. But if we really were serious about par concern, everybody on this list, we'd have to be selling and probably quite a few more. So.
And I tend to agree with you. I agree with you wholeheartedly that we're doing well, and maybe by being a little bit more picky going forward, we can do even a little bit better than we've been doing. Yeah.
And that's partially a hazard of the size of the portfolio.
Yeah. Yeah.
That we have.
Mm-hmm.
Yep.
All right. Well, on the flip side of the coin, we've got First Financial as an example. By the way, we've got Teva as a 4-time selection, so we're down quite a bit. But
Yep.
First Financial is a 1-time selection. That one time, $1,000 is up to almost $2,000. So, Cy, thank you for that one. That's probably to me an example where we might, especially if that par gets any lower,
Be looking at selling.
Mm-hmm.
Absolutely.
And celebrating.
Yeah, Mark, why don't we kind of devote the next roundtable to looking at maybe the bottom 8 or 10 holdings,
Okay.
as long as they're all underneath average, and trying to do a little bit of serious house cleaning down near the bottom of the portfolio then.
Okay, we'll basically look at doing that. All right, let's go ahead and get started with our stock presentations. The first one tonight is Alliance Data Systems from Kim.
Mark, I'm going to break in. I do have a hand in the air from Carol. So, Carol, I'm going to unmute you, and now's your time to speak. If I can get you. There we go. Carol, you're unmuted. So do you have something to ask us? It's Carol C. Okay, and that might be an inadvertent hand. Okay, I'm going to take the hand down and continue then, Mark. So,
Okay.
Kim, take it away. It's yours.
Okay, I'm going to present Alliance Data Systems tonight, ADS. I kept thinking that ultimately, we hear data, so could I find a company that was about data? And Alliance Data Systems is with its subsidiaries, provides data-driven and transaction-based marketing and customer loyalty solutions. So, and those credit solutions, and it's worldwide, United States, Canada, other countries, and they have different groups of the Loyalty One, Epsilon, and a credit service segment. So that's why they're, if anyone wonders, when you look at it, their debt looks so bad, and that's because of their credit service segment that they have. Next slide. In providing all that data, when you have different clients who don't want to do all that marketing and get all that collation of all that data and find out who their loyalty clients are and analytical and strategic consulting and stuff, they do that for you with all that data that they can collect for you. And it's proprietary, that data, and there's a lot of companies out there who don't want to do it. So they like to correlate all that data that is collected and provide a service for their clients. Next slide. This is their market right now. Their total market, you can see right here, is they've got a lot of different apparels and furniture and jewelry, but they have quite a bit more addressable market from their PowerPoint presentation from the last quarter that they addressed, that they feel that could be really benefit from them. And they don't really feel that as much as Amazon is growing, they still feel that there is a lot more for them to be able to grow. Because the large department stores are not, as it says here by this slide, clients of ADS or their prospects. Next slide. They feel like companies are going to a massive shift from the general marketing to direct, the data-driven. And since this company is all about data, that's where they feel that they will shine. And we can recognize some of the names here at the bottom: Signet Jewelry's Jared, and Alto, that's been picked at the roundtable quite a few times, and it's done quite well for us. They feel that in the retail area, that is their bread and butter. And retail sales at 15% online versus their share of 30 to 40%. So they've got a lot of growth potential there. Next slide. This is how that management consulting market side has continued to grow, and that's what they do. They help market different companies, so they take that data. So I felt that this company was one that everyone should consider because they're in that niche area and they continue to grow. Next slide. This is the front of the SSG, and as Ken likes to talk about, up, straight, and parallel, that's pretty good right there. You can see your 2-year estimate of growth would be 7%. Earnings per share is 16.8. Not too shabby. But the company also believes that because of tax reform, that they feel they will be able to add $100 million of free cash flow for 2018, as well as their earnings are going to benefit from the tax write-off. So that's something else that's really going to help the company also. Next slide. Here is the back of my SSG. If you'll notice at the very bottom, the current PE average is 28 and the current PE is 14.5. That is our step 1 of the Nicholson triple play, and that's one of those, I love the Nicholson triple play. It's kind of equaling to cha-ching if everything falls in place right. So I really feel that this stock is one that anyone could consider, because look at how low that PE is, so that it can have the capital appreciation so the PE can rise. Next slide. On the back here, I have a tendency to be really conservative, and the high PE has been 18 is what I projected, but as you saw in the last slide, the average PE was much higher, and I was just keeping it at 18 as for what last year that they did. That's where I went at 18. It was 18.99 for their high PE last year, so I just went 18 because I want them to be able to do equal what they're doing now and go be stronger going forward. So I find it in the buy range. Next slide. This is the last from February 23rd, the value line. And Mark, with that wonderful little red pencil that you have, could you circle the 2021, 2023 projections box? See at the bottom there where it has the annual total return at either 13% or 25%. Number one, that's one of those things I like to look at because the PE is, not the PE, that the annual return is greater than 10%. That's one of the criteria that I have to have for me to be interested in a stock, is that the value line sheet, if they have one, has to be able to be greater than 10%. The second thing is you've got where the PE ratio is 9.1, and this was the value line that was as of May 25th. And I did this presentation at Bank 2 weeks ago, and I was shocked that it was already there. And this closing price when I did this slide was $210.09, and it closed today at $209. So we're just difference of $1 there. So you can see where the PE ratio of 9.1, it might be rather small there, but the median and average, that PE is still below both of those. And so that is the second portion of, that's the first portion of the Nicholson triple play, that PE is so low. And where you have the solid line mark in the middle of the box there, and then you have the dot, dot, dot. Anytime that you can see the stock price bars go below that dotted line, that is where you're showing that you have, that's called, it's undervalued by cash flow. And on the right-hand side of the slide, you can see where the cash flow per share of $42.80 minus the dividend that the company pays out of $3.48. Minus the capital spending, because they have to use some of that cash to grow the company, gives you $32.67. And the legend box, which was at the top of the value line, says 8 times cash flow per share. You multiply it out, that says by cash flow, the stock alone should be $261.36. So it's got, just by cash flow alone, currently the stock price is at least $50 undervalued, and that would also equal to at least a 25% growth in the stock. By looking at the cash flow per share, I like to make sure that the cash flow is rising, and that is. I like to make sure that the common shares outstanding, you can notice where those are going down. They've been 55, 53, 50, and they also currently have 100, they bought back 1.5 million shares in the last quarter at an average price of $238, but they still have $446 million available to buy back more shares. So they'll be able to buy back more shares at a great price, and I love it when you've got great management who is spending their money wisely to be able to grow the company, because they're not, buying back shares when it's way overpriced. Now, another aspect of the Nicholson triple play is you want to make sure that their profit margin is consistent or rising. And you can see that this company, since 2014, 2013, it's been 15.5, 14.8, 14.6, 14, 14, 14.4. It's going to be 15 and then 15.3. So this company is keeping very, very consistent margins. So that's the next part of the triple play. And you can see by what the projection box is that they think the stock price at a low could go to $330 or a high or 495. Well, as that PE expands, guess what? Our stock price expands, and that's my cha-ching, cha-ching. And the other thing I really am very consistent on looking at is my return on shareholder or return on total capital, because I want to know the company is very good and consistent on allocating the funds to grow the company. And you can see where this was 8, 9, 11, and they anticipate going out and forward of 14. So they're very efficient, and the return on invested capital is above my threshold of greater than 10%, and they are growing that and being more efficient with their money. I truly love that. Okay, next slide.
Kim, could I break in for a moment, please? Would
Sure.
you answer about why, again, I know you answered it once during your presentation, but we have a couple of folks want to know why the debt is so high.
Well, they have a credit card servicing aspect that they do, and because of the credit servicing, it looks like they've got a lot of debt on the balance sheet. So there you go. Yeah. Their brand loyalty division is trending upward, and that will be positive for them because they have signed things for the World Cup, the Olympics, and Disney. I recognize that as interest rates rise, that could change, and they're planning on protecting themselves by hedging. And where you can see that this company, they have raised their earnings estimate because its outlook for the share earnings of a range of $22 to $23 for the full year. They've increased that to the high end because that credit business, which will be a growth driver, brought about by the move more collections in-house. So they've got a lot of the solid long-term price recovery going forward, and that will help with the reducing charge-off and broaden those margins. And we love it as an investor when our margins expand. This company has a B++ for their financial strength, and I always like when that's really good with the company because that way that overall that they're doing well. Okay, the credit card services divisions has been impacted due to the Dodd-Frank, and with our elected president, you never know if he's going to repeal any of those things, so that eliminates some of the tightness of the market and difficulties there. If they release that, that would help also help their credit service division there. So this is just a stock I hope everyone would consider to look in their portfolio.
Well, good stuff. It's
right.
Been selected a few times. I would just add one other thing to the debt discussion. It looks like their effective interest rate for debt that they take on is about 2.5%. So that's a part of that answer. They're again allocating capital wisely if they're accessing that type of money, as long as they can get a higher return from their operation.
Right. And also realize it's called card services, but they are actually issuing credit cards. In fact, when I evaluate ADS, I question whether it should be evaluated as a services company or as a financial company. Now, where that is a little bit riskier than a bank likewise will have a high level of debt because it is debt that they use to issue credit and other loans, or credit cards and other loans. The ADS does not get their debt from deposits. They get their debt that they then reissue as credit cards in the open market, which, as you just pointed out, Mark, right now is at very good rates. But if interest rates zoom in price, that could conceivably squeeze ADS more than a bank might be squeezed, because while banks, of course, have to pay higher on their deposit accounts and particularly checking accounts tend to go up much slower than general market debt.
Mm-hmm. All right, thanks. Well, let's go ahead and add another ADS to the portfolio, and we will go to Ken's selection of CBRE.
Thanks, Mark. If you'll go one slide in, we are one slide in. Okay. Yep, another hit.
Another slide in.
There we go. Okay. CBRE is a leader in a huge worldwide market. This is a giant-sized company. You can see the offices all through North America, Europe, many of the offices in Southeast Asia, some in the Near East, the Middle East with the Arabian Peninsula. They're moving into India very aggressively, and they have offices in South America, Australia, New Zealand. The only place where there's not a lot of movement is anywhere in Africa except maybe South Africa. So this is a giant company, and let's try to explain what it does on the next slide, if you would, Mark. CBRE started out as a company that only accomplished what the aqua-colored part of this bar is explaining that they still do as part of their business. They started out as a simple real estate company that represented buyers and sellers of real estate, and then once they matched buyers to sellers, they were able to arrange financing for these for the two people that were buying and selling the particular parcel or building or whatever you're talking about. That was the original business. Today, they still do that business, but it represents only about a quarter of its total income. As you can see from this bar graph, they have a very small amount, less than 2% of their business, where they're using institutional capital to make investments in real estate development. So they're actually being given capital by some of their clients and said, will you invest this for us in real estate? But that's a very small component of their business. Most of their business today is under contract, and the contract is in two separate divisions. One of them is leasing, where they represent the tenants and the landlords in various leasing transactions, and then for setting up the lease and collecting the payments, they're under contract to do that, and of course they make a profit by doing that from one side or the other in the whole process. The largest source of their business today is property management. They might manage a resort, for example. They might manage a complete condominium development. They manage facilities and projects for people that are occupying these properties, and they also manage for investors that own the properties. Again, that's all contractual, 44% of their business today. So you can see, and if you'll click again, Mark, you can see that about 75%, 74% is the published number of their business is recurring revenue coming directly from contracts. You can compare that to about 11 or 12 years ago, where that represented 61% of their business. So they're moving towards a more renewable, more reliable source of income, and that becomes much more predictable as the business continues to grow. Click again, Mark. They've also been moving towards larger and larger clients. In the last 15 years, 15 years ago in 2012, one of their clients was valued at more than $100 million. Today that number is increased to 17, and you can see the corresponding increases in other tiers of client size. The client size helps keep things predictable, helps keep those contracts being renewed, and helps them have a stream of revenue that we can depend on year after year after year. It also makes it very difficult for other people to move into these extremely large clients who really don't want to change if there's no real good reason to change, who don't want to change because of the sheer size of the contract that they would have to then reissue and learn all the new regulations and rules to go with them and everything else. Click again, please, Mark. Here's our value line, and there's been a couple people in the audience that wanted to re-explain Nicholson's triple play. So I've chosen a triple play as well, and let me try to explain it using the value line. If you'll do one click, Mark, you'll notice up in the projection box in the upper left-hand corner where I've circled, you've noticed that I'm looking at double-digit returns at the high side and the low side. Now these are value lines opinions, and that's my dachshund who is very upset that there's a cat in the backyard, and that's my wife chasing her down right now. So that's one of the things that Nicholson said was the beginning of a triple play. You need to have a stock that had a depressed stock price. That was the terms that he used. And I interpret depressed stock price as having double-digit returns going forward. So that was point number one of the three things that need to be in place. Point number two, I look at the PE ratio at the top. That's the median PE ratio for the stock. 14.8 in this case, and then I compare it to the call that's being made for the PE 3 to 5 years from now. I'm looking down at the average annual PE ratio. My circle got a little bit big there, but you can see that it's 18, and Nicholson said there should be a probability that the PE can expand. So going from 14.8 to 18, that's certainly PE expansion. So that's leg number two. And then I look at the net profit as a percentage line, and that's down there. I put a box around it. And I look at the 4 or 5 most recent years, I see going backwards, I see 6.5, 6.0, 6.3, 6.2. And then I go to the far right, and I notice that 3 to 5 years from now, value line suggests that the profit margins might be 8.3%. The third leg of a triple play would mean that there's the possibility of margin expansion as well. So a depressed stock price, the possibility for PE expansion, and the profitability for net margin expansion. Those three things are in place, and therefore this becomes a very interesting stock for me to study. Next slide, please, Mark. Here's what the graphs look like. They're reasonably straight. They're moving in an upward direction, and they're reasonably parallel. I'm getting a nice trend on profit at the very bottom of the slide, a slight downward trend on return to equity, and debt a little bit at the high side. Remember what these folks deal with. They will carry a little bit more debt than the traditional company might carry, but their interest coverage is more than enough to handle that debt, and they borrow the money at fairly reasonable rates. Notice the red tick mark on the latest price bar. You'll see that it's trading near the top of its range right now. I suggest that this company might grow sales by about 10% and earnings by about 16% going forward. Next slide, please. Here's the results from my SSG, which I consider to be reasonable. I like to come down on the slightly conservative side of reasonable. I believe you can be way too conservative and way too aggressive when you do an SSG. So I'm looking at my analysis of a par value of about 13%. I then love to use Manifest as a validation of my own reasoning. Manifest is suggesting a par value of around 15%. Remember, Manifest numbers are coming from a conglomeration of a number of different analysts. We're screening numbers from a large number of analysts, kind of massaging them a little bit, and then doing a traditional SSG to come up with the par value based on the analyst opinions. When I'm within 2 points of what's going on here, I'm feeling very validated in my own analysis. Next slide, please, Mark. That paragraph in the upper right is the final paragraph in the value line analysis. I like that number that they give me of $4.50 share net. My analysis had share net of $4.49. So again, I'm feeling validated by an outside source. The paragraph beneath that is coming from the value line report for this company, and I really like to see a company that I'm studying be characterized as having a wide economic moat. What that means from Morningstar's point of view is that it's very, very difficult for somebody to start up a company and begin to compete with this company immediately. The barriers to competition are high, and they use the words economic moat to suggest that by saying that it's wide. The stuff on the right-hand side of the slide comes from Manifest Investing. I'm looking at the industrial services industry, and that's where CBRE is placed in Manifest. And notice that it's the second out of the top 5 companies there. I did take a look at the other companies in there. I happen to own Healthcare Services Group. I happen to own Air Lease, and I just took a position in CBRE. So I own the top 3 companies in this industry. Remember, please, that the names of industries change from value source to value source to value source, and CBRE, I think Morningstar places it in the real estate industry rather than in the industrial services industry. I look at the top stocks in industrials as they play, and again, CBRE is one of the 5 top industrial stocks based on Manifest classification of companies. All in all, I think that it is the kind of company that I haven't studied in any great length. It added some interesting diversification to my portfolio, and I'd like to add a holding of it into the roundtable portfolio as well. Thank you.
Good stuff. Thank you, Ken. With that, we'll switch to Cy and yet another Cognizant Technology moment.
All right, thank you, Mark. And you mentioned earlier that no one decided to change their selection since the conference, figuring that the audience would be wiser or more favorable this time around, at least to those of us who did not get a second pick affirmed by the audience. And of course, since my pick of Cognizant came in last, I guess I'm being the most stubborn on that. But with that said, I'm not going to lobby the audience too hard tonight. I will mainly go ahead and say up front, as I briefly did at a convention as well, this presentation tonight really is more of an educational presentation on why Cognizant, you should not be considering selling Cognizant if you hold it. I also, on the other hand, do feel that if you don't hold a lot of Cognizant, which I personally do in my portfolio, I would strongly consider buying it. And I think that it is a good addition to the portfolio, and that's why I'm picking it tonight, and we'll leave it to the audience whether or not to add even more. But as you can see, up straight and parallel, let's go to the next slide. This is, again, just a quick summary of the business. I think we all basically know what Cognizant does. They are an IT outsourcer. They're a firm that does IT services primarily for medical and financial companies, although they have a wide variety of companies that they service. And you see digital has become their buzzword, business operations, and then the systems and technology sector or divisions of the business. Next slide. Here's the teaching point that I wanted to make tonight with Cognizant. In early May, you see a significant price drop, about 10 points from the all-time high of 85 and about 8 or so from the price that it was on May the 6th. I believe the price drop was May the 7th. First of all, put that drop into perspective. It only fell back to where the stock had been in February. The stock was up significantly for the year, and then even before 2017, it only fell back to late last year. So it's not even though it's a huge day drop, the stock had been up significantly. Next slide. So then we ask the question, what happened? Well, here is what happened. The company issued a financials release, and notice the words, solid start to 2018. They were up to almost $4 billion in sales, over their projection, over what the market anticipated. They were also year-over-year increase in earnings of 10.3%. That's the number that probably got some people's concern in the market. And I want to kind of walk through why we should not be concerned if you own Cognizant or if you're strongly considering buying it with a 10.3% year-over-year increase. Again, notice the non-GAAP earnings are up significantly. Next slide. Here's Value Line. This was, even though it's actually dated after the price drop, it was written before the price drop. Notice Value Line was projecting $1.05 for earnings. Cognizant came in higher than that, so they were right in line with Value Line's projection. And notice Value Line also believes that despite the early price appreciation during the year, it's still looks like there's solid long-term appreciation for most investors. And of course, that was at a price of 81. It's now today in the 74.50 or so range. When I prepared these slides, it was 75, a little over. Next slide. Here, it's held in the growth stock outlook column, model portfolio for the column I write in Better Investing. Notice back in December, I lowered my projected growth for Cognizant to 9%. So again, they're still above the growth rate that I was projecting, as well as we just saw Value Lines. Next slide. And here is just a quick comparison on the stock selection guide. Notice a 10.3% sales growth. Analyst consensus for the next 2 years is 9%, so they beat at least a shorter term projection. And notice again the forecast on the SSG. And this is, by the way, this is the SSG that I use for the growth stock outlook column. It's that you can see the results in every column, although we don't publish the SSGs every month when I write. But this is that. Notice again, it's above the concern. So what is tragic about a 10% increase when everybody's projecting 9? It's right in line with what we expect to happen. Next slide. And then this is just a historical look at the trailing 12 months sales growth projections over the last 3-4 years. And the numbers at the top of the graph, the 19, 16, and 9, that's what I was projecting with the growth stock outlook at the time. But you can again see that Cognizant has significantly decreased its growth by and large because of the fact it is becoming a very large company and is slowing down normally. There is some issues with its European business, but by and large that has resolved as the Eurozone has kind of snapped out of its recession. But it's primarily long-term growth is going down because the company is bigger. And you can see that, again, it's nothing historically alarming by the report in May. Next slide. This is just comparing it to its industry peers. Infosys, EPAM, and GIB, which is the CGI group. They're, again, all IT outsourcers, and Cognizant is the fastest grower with the exception of EPAM, which is about, EPAM is still growing at about the 20% that Cognizant used to be several years ago. Next slide. This is profit margin. Again, Only Emphasis has a higher profit margin. So again, compared to its industry peers, Cognizant is doing very well, is very consistent, in fact, more consistent than its peers. Next slide. This is just my judgments on the stock selection guide. You can see the PE ratios. I ended up using, I believe, in this particular case, it's, yes, just use the historical average for the last 5 years. And again, notice earnings per share is projected to rise significantly faster over the next 5 years than sales, due in large part to that last line you can see, which is Cognizant is using a good bit of their cash flow to buy back stock. Also, notice because of the Tax Reform Act or the Tax Reduction Act passed in 2017, income taxes have fallen. So that, at least on a one-time basis, which would still be included in our projection looking forward, would also account for earnings growing faster than sales, although that's going to be realized basically in the next quarter or so. Next slide. This is the bottom line. All of those projections, 13.7% potential return, which is solid in this market. Again, the real message of these slides are the market reacted. There seemed to be a lot of concern over Cognizant, and as normal, it seems to be much ado about nothing. At most, Cognizant maybe got a little ahead of itself early this year, but notice it is still has a relative return of about positive relative return of about 6 or 7 percentage points relative to both the Dow and the S&P 500, even after that price drop. So I'm saying let's add another Cognizant.
Okay, one more log on the fire. All right, thanks, Si. Let's go ahead and go with Nick and his presentation on Five Below.
Well, I'm ready to do an awesome presentation.
Okay, go for it, man.
So give me a slide. When I started looking at a stock to study, I went to the sweet spot screen that Mark has on the Manifest Investing site, and one jumped out at me right away, and that was Five Below. The reason it jumped out at me were a couple of numerical things, but also a personal thing. I really like the high quality rating, the 98. I like the PAR being 15.1, high financial strength. The PE is a little bit high, but it's below its average at 29. So I also think of the fact that I have 2 daughters in college and a son in high school. And guess who their target market is? Exactly the folks that I live with. So, Mark, can I have the next slide, please? Five Below is typically in your strip malls. Their standard footprint is about an 8,000 square foot store, and they basically put materials in there, put inventory in there, and they sell it for $5 and below. That's why they came up with the name. Excuse me. Next slide. What they do is they tend to focus on about 8 wow product areas: sports areas, technology, creatives, and I like the names in there, the crazy slime and the unicorn poop. They tend to have party supplies for when you want to have a party. They have candy. They have focus on teenagers in their rooms and decorating their rooms. They have style for the young ladies in the crowd. And they also focus on a now section where they have things for the current time. So you can see here, the summer's coming along, so they have floaties for your swing pool. They have beach towels. They have wakeboards. They have goggles for swimming. So they focus on those 8 areas. Next slide, please. They also tend to get involved with some of the most crazy trends, if you will. Those fidget spinners, those kids that have those things, they always seem to be spinning those things. Everybody needs a selfie stick, even some of us older folks, so you can get them there. Those bracelets, and again, the slime. They tend to focus on strong licensed brands, not just cheap stuff. So even though it's $5 and below, it's not cheap stuff. They work with Disney. They work with Star Wars. They work with Hershey. Taylor Swift is in there. And as Mark said at the conference, and I can attest to too, Lego is an important function, especially when you have like his grandkids, but my son was that way too when he was little. So they focus on big name licensing, so they're not putting junk in their stores, they're putting good stuff in their stores. They also look at on-trend stuff. The first thing there on the top left, They have a helicopter that's like a drone. They have yoga fitness mats for all those crazy people that are in, well, I shouldn't say crazy, but all those folks that are into yoga. They have backpacks, and schools will be coming back in. I mean, the schools are just getting out, but back to school will be coming around, and so they have backpacks. So they have lots of things that are of interest to that teen and tween and young adult types of folks. So next slide, please. Here's their target customers. They really are focused on the tweens and the teens, 8 to 14-year-old girls and boys, but they're also focusing on their parents. So they're looking at the folks that are going to be the parents of these kids too, and marketing to them so that they have a much broader appeal for their customer base. Next slide. When you look at a company, and we're looking for growth companies, we like to understand how they're going to grow. So I found this on a slide from one of their presentations where they talk about 5 distinctive drivers of their growth. They have hand-picked, trend-right wow products. We saw those in their presentation. They look for things that are of exceptional value, and that's why they go to those name brands, and they sell them for $5 and below. They want a fun and differentiated shopping experience for those teenagers and their parents. They are very disciplined about their growth, and we'll see in a couple of minutes here about how they're managing their store growth throughout the geography of the U.S. And they tend to stay focused on the teenagers and the tweenagers. The good thing is, too, is that they're led by a very highly experienced management team who's been around for a while. Next slide. Here's their geography. I looked at this company about a year ago, and when they were talking about 2017, they said they wanted to open 100 new stores. Well, in 2017, they actually opened 103 stores, so they delivered on their expectations. So you can feel pretty comfortable that they're going to continue to do that. And you can see over the history, this company's been public since 2012, you can see over the history that they've been growing their store count by about 20% a year. This year, 2017, was their first steps into California, and in 2018, their expectations are about 125 stores, and they're going to be moving into Arkansas for the first time. So next slide. Here's take a quick look at the front side of their SSG. We've all talked about up, straight, and parallel tonight. Well, there's up and straight and mostly parallel. You can tell by the red tick too that they're trading at a bit of towards the high end of their 52-week range. The stock price has come back a little bit from the time when we met at the national conference too. It's traded today at about, it closed today at about $70.70. You can see here this estimated sales, stay there a second. The 2-year estimated sales growth for Morningstar is about 20%, and the long-term earnings per share estimates over 26%. Go ahead, Mark. What I like to do when I'm studying a stock too is capture all this information so that I can take a look at it and see what I want to do in terms of my estimates when I become the analyst for the company. So I look at what the company says. They say they have a target of growing at 20% a year. In 2017, their comp store sales were 6.1%. Over the years that they've been public, they've been middle single digits, and in some years they've been in low double digits in comp store sales. That's an amazing ability to be able to continue to grow comp stores at that high of a rate. And they want to have 125 stores, new stores next year, so that's about a 20% growth rate on stores. So if they're able to deliver even half of the comp store sales next year and continue to deliver their 20% store growth, there's a potential for about 23% increase in sales and growth. When I look at some of the other places, Yahoo says they're going to grow about 24% 5 years out in earnings. NASDAQ says it's going to be over 26. Value Line, and I don't have the Value Line sheet here, but if you pull up the Value Line, you'll see they're talking about 18% in sales and about 22% in earnings. And Morningstar only gives you a short term, but they're talking about 22%. Also, again, because this is a retailer and store growth is so important, I just take a look at and count down what they've done. You can see they did 19.7, so roughly 20% in 2017, and they should be able to do 20% again. I really like the idea that they have a long-term target of 2,500 stores. So they're going to be moving pretty strong across the geography of the U.S. Next slide, please. Okay, again, understand that the IPO happened in 2012. The growth for this company over the 5 or 6 years that they've been public has been over 30% in both sales and in earnings per share. I put my forecast in at about 18.5 when I took all the information that I just talked about in and thought about what I wanted to do. And I worked it out, and I'll show you in a second the preferred procedure where I come up with 20% growth for the earnings per share. As far as management goes, pre-tax profit on sales is increasing. We love to see that. The return on equity, while it's red and declining, I'm okay with it because it's been pretty stable in the upper half of the 20s. I'm okay with that. And the debt to capital is 0. They had some debt in the prior years, but now they're at 0. They don't really own any real estate. They tend to lease their places, so they don't have to take on any debt. Next slide, please. Here's my calculation of the income statement using the 18.5% sales growth. We've talked a little bit about the margins growing, so I've improved the margins to about 12.5. The tax rates, we all know, have changed, and I'm being pretty conservative by dropping them just to 30%. They could go even lower because they were on the 35%, which was the corporate tax rate previously, so they could drop into the 20s even. And they tend to be stable in terms of their dividend, the shares outstanding. So that brings me up to my earnings per share growth rate of about 20.5. So next slide. To take a quick look at the forecast for the future. Again, it closed today. When I did this, it closed at 71. Today it was about $70.70. The high is about 78. The low this year is about 44. I used the high PE of about 35, which is about the average PE as it is right now, which brought me to 163. And I used the forecasted low, which is roughly the same as the low this year. Gives me a forecasted upside downside of 3, and it gives me a good potential price return. So if we go on one more, we have section 5, and here's our zoning. Right now, it doesn't pay any dividends. I'm okay with that. And we look at the return based on the high PE of about 18, the average PE of about 13. If you remember from the beginning when I started talking, the par was about 15. I tend to take a look at that and say, okay, 13 to 18, I expect to get a return somewhere between those numbers because I know I've done the work, and we all, as better investing investors, do the work on our stock selection guides. So we understand what the PE is going to look like over the course of time. So we'll be able to not necessarily time the need to sell the company and take the returns, but we'll be able to understand when it's above the average and be able to take advantage of that. So I tend to say that this might be a 15 to 16% returner. It's in line with that manifest return of about 15. So I feel pretty comfortable adding this to the roundtable portfolio.
All right. Thanks, Nick. Another awesome rendition.
Thank you.
All right, I'm going to go ahead and wind us up here fairly quickly. I didn't get many votes in Orlando, so I don't have any false aspirations here. I do want to tell you where the idea comes from. It comes from Brown Capital Small Company Fund. Many of you already know that's one of our favorite funds to watch because these guys have shown that they know what they're doing for multiple decades. This is one of the best small company mutual funds out there, and I will admit to sometimes being lazy. And I do let the analysts who work for Brown actually do some work for me every once in a while. And so I watch their choices. We'll look at that here in a second. This goes back to Eddie Brown, founding the firm back a little over 30 years ago. He was a frequent guest on Lou Rukeyser, for those of you who remember that. Eddie knows what he's doing. He actually has some, I believe he has some investment club background. And the team that he's assembled over the decades is just exceptional. You can see from their returns down at the bottom of the page and the graph in the middle of the page that they have actually outperformed the market consistently over the years, and they do earn super investor status, beating the market over the long term by more than 5 percentage points. This is very rare stuff that they're doing. This is a look at some recent activity inside the portfolio. And again, we will often go here for ideas. By the way, Zoe's that I picked last year was actually the top performing selection so far for the trailing year. We actually added that after it had dropped significantly from when they originally selected it. And the Brown team continues to believe in the future for Zoe's. On this particular report, we're looking at this new listing in the fund portfolio with the starburst over here on the far left, ALRM.com, ticker symbol ALRM. Relatively new company, but some fairly interesting trends taking shape. So again, this is a little bit less traditional. A number of you just fainted and said there's not enough years here. I get that, but I also know that these guys tend to find companies very early discovery in the life cycle process, and we want to have some of these fairly rapid growers. And this is one we want to dig into a little bit closer, see what Brown sees, see what we might be able to see. What do? They do home and commercial business security. And it's the kind of stuff, kind of a do-it-yourselfer type, install the webcams, install the devices around, the lights and all that kind of stuff. You can operate it from your phone. The interesting thing is that they serve as the platform for a number of fairly noted firms like ADT and the United Technologies Chubb systems that are out there. So this is the stuff that they make. They make these security systems. Here's what some of the recent consistent revenue growth looks like. Again, as the stock selection guide visual analysis shows you, these guys have been pretty consistent over the last several years. You can see that they are expanding on both sides of the business, from the licensing and the royalties to the hardware and the other revenue that you see. So again, they're trying to add subscribers, add systems, grow across some of that commercial business, and they've been doing a pretty good job of marketing and pursuing opportunity. Their profitability in this expansion of business and the pursuit of the opportunities has maintained pretty steady, and that would show up in Section 2A over the years. So again, steady profitability. And again, just a quick look at what it does look like. Again, fairly early stage. That'll give some of you the heebie-jeebies, but we see steadily increasing profit margins with the opportunity and challenge to stabilize somewhere in that 15 to 20% range for profitability. And of course, PE ratios are going to also come down and land and hopefully stay somewhere in that 20 to 30 range over these next 3 to 5 years. But again, a fairly compelling picture. Again, the real story here is the Brown team, the Brown small company mutual fund team, and basically leaning on some of their fine work over the years. So again, you've got 4 rather traditional selections that you could think about, and then this one new exciting opportunity that when it comes to voting. So I'm going to add ALRM to the tracking portfolio, and Ken, I think we can do a poll.
Mark, if you could give me just a moment. I got to get this poll ready to go. I forgot all about it, okay?
Oh, jeez. We can't do a show of hands here, Ken. So
I know we can't, so just give me a second here, okay?
I'll tell you what, with all those 4 traditional stubborn, selections by my other 4 participants, I'll just put this picture up on, for the audience to dwell on as, what might possibly happen here.
Okay, and I'm almost there, Mark. All right.
Nimble fingers
Mark,
at work.
I think you're just trying to remind the audience that the last one should stick to everyone's brain, and that's what they should vote for?
Well, that can often be the case, but I mean, this is a significant opportunity to do very well.
Okay, Mark, I think I'm ready now. Hold on.
The other thing too, Mark, is you don't have friends in the audience who are voting for every stock this time either, so might have a chance.
Oh, that's true.
Yes.
We had voting irregularities in Florida.
So no hanging chads tonight, buddy.
Right. And I think this audience actually likes earnings.
You think?
Although this is, in honor of Hugh's absence, I guess you're doing a Hugh McManus.
Okay, look at that.
Just miss it while your nimble fingers can. Is it actually open?
It's open and people are voting. Folks, all you need to do is use your mouse, or if you're on a touch screen, your finger, and choose the one that you think you'd like to add to the portfolio right here. I'm going to wait till about 90% plus of you have voted. We're up to 78. We're up to 80%. So if you haven't voted, if you're brand new, it doesn't cost you anything. Just take and pick the one you think you might like best. And we'll go from there. Let's have one more person vote to push it over there. It goes over 90 now. Okay. So I'm going to close the poll. And I'm going to share the results. And they're fairly close to where they were in Orlando, except Mark, you've really come up a little bit here. So you've gone from last place to third place, Mark, okay? And poor Cy has moved to the very bottom right there, but we'll put another position of Alliance Data Systems into the portfolio. We had a virtual tie between, in fact, I think Five Below was one ahead of ADS at the Orlando session. Am I right, Kim and Nick?
Yeah, I think that is about what it was, but the hanging Chad question came into play, and so we went with both.
Yes, we had two women sitting in the front row that were voting for every single stock. They liked all five of them. So.
They were
Okay, I'm going to close this poll and go back to the presentation now, Mark.
I'm sure they would appreciate you calling them young, Ken. You can go right ahead.
Okay. Well, I got into trouble with that with Ulta a year or so ago by calling a person young when they weren't as young as they really should have been. So anyway, here we go.
Ken, you need to move on, Ken.
I need to stop digging this hole any deeper.
Take the shovel.
Yes, I think so.
Mark and I will be coming to you folks again on June 5th. I'll be coming to you from the mountains of Tennessee, and Mark will be in beautiful Rochester, Michigan. But Turnout Tuesday is next Tuesday, June 5th. I'll be at the Heart of Oklahoma chapter in August doing a full-day presentation. Cy and Mark will be in Atlanta on the exact same day doing a wonderful, wonderful investing day program down there. Mark is going to be partnering with the American Association of Individual Investors, and sponsored by the Washington, D.C. chapter, and that's on October 20th. And I'll be down in Charlotte, North Carolina for a joint program between the North Carolina chapters and the South Carolina chapters. So we'd love to see and meet any of you that are near any of these venues. If you were to go to the website of the chapter that are sponsoring these particular days, you would find out details and how to register for them. We'd like to thank everybody for making this a pretty decent set of webinars here. I was surprised that we were able to stick pretty closely to script on both days, Mark. Thank you so much, Kim and Cy and Nick. As always, Mark, you are greatly appreciated. And the folks that make this possible, thank all of you for all of the work that you do, all five of you. We'll see you again for the roundtable. And you'll get a reminder in the mail as to the actual date for the roundtable next month. Any last comments, Mark?
No, just thanks everybody for showing up on this hot summer day. I don't know what happened to spring around here, but
it happened 3 days in February in Pittsburgh.
Yeah,
we had 3 days of 70 degrees in Pittsburgh. That was spring.
But
Mark,
I do want to just again just reiterate the congratulations to the award winners from the National Convention. We do honor and appreciate their service, and again, thanks everybody for.
And Mark, I'm getting a note from Cynthia McCrary and from Claire Redmond that the Atlanta Investing Day is August 25th, not August 18th.
Oh, okay, I'll have to make that adjustment.
Okay, so again, I'm going to repeat that for those of you that are still with us. The Atlanta Investing Day is August 25, not August 18. So please, if you were getting all excited about going to Atlanta on the 18th, it'll be on the 25th instead. So I hope that Mark and Cy will see a lot of you there. And any last comments from anybody else in the panel? Thank you all. So go on, Cy.
I was just going to say, I can assure Claire and Cynthia, I just checked my calendar. I will be there on the 25th. We'll see when Mark's there, but
better check that airplane ticket.
Yeah. Thank you all for coming this evening, and I'm going to close the webinar down. Good night, everybody.
Thanks,
good night.
Good night, everybody.
Bye.
Bye.